Hi, welcome to another video, where I would like to focus on the topic of passive ETFs, which are not actually as passive as we think. We hear it over and over again. Invest passively in the S&P index, or the MSCI World Index, and you won't have to worry about a thing. Passive investing is king. Don't do anything else. In fact, you don't even need to know anything because it's so easy and everything is done for you. But what is the reality? What obstacles might we encounter? And is passive investing really as passive as it seems at first glance? What if everyone invests passive? What then? Will we just keep growing? I will focus on all these questions in this video, but I won't keep you waiting any longer. So sit back, relax, and let's get started. To clarify from the outset, passive investing means investing in passive ETFs, primarily equity ETFs, that track a specific index, such as the well-known S&P 500 index, or the global MSCI World Index. On the other hand, if we want to select individual stocks, known as stock picking, then this is active investing, which requires a lot of time and knowledge. There are also actively managed funds, such as Consec Active Invest Dynamic and others, where a portfolio manager actively selects dozens of stocks to invest in. However, historically, more than 90% of actively managed funds fail to outperform passive funds, which is why this type of investing is so popular. But back to passive investing, what exactly is an index? An index is actually an indicator of the performance of a given region or sector. In the case of the S&P 500 index, it shows us how the 500 largest companies in the US would. However, the index is only an indicator and we cannot invest in it directly. That is why ETFs, or exchange-traded funds, were created in the 1990s. Their main objective is to replicate the composition of stocks within given indices, which means that we participate in their performance and own shares in up to several hundred companies. Of course, there is a minimum annual fee for the fund manager, ICIEG, 0.1% per year. We can purchase these funds from any broker, IIE, an intermediary, where we simply need to register and we can get started. Purely theoretically, this could be enough for a complete beginner, allowing them to start investing passively, right? Yes, but this immediately raises several important questions and decisions that we need to make. 1. For example, which index should I choose? Just the US or the global MSCI World? 2. Or maybe some other one. And should I invest everything in stocks or include other investment assets as well? 3. And where should I invest? Through which broker? XTB, Trading 212, eToro, Interactive Brokers? 4. And if I choose a broker and enter, for example, an ETF on the S&P 500, then we will find a gazillion of them from different managers, in different currencies, and on several exchanges. So it's not that easy, but if we answer the questions mentioned above, the result will be that we will have one broker, one or more ETFs, and we will know what we are investing in. Then we set up a standing order and regular investment, and it will be completely passive, and we won't have to deal with anything. If we invest for 10 or 20 years or more, it will be easy, and only in the event of a decline will we buy more or invest a higher amount than we invest monthly. However, I would now like to take a closer look at the creation of the indices themselves, such as the S&P 500 index, and answer the question of whether it is really a purely passive index, as it is said to be. In reality, it is not entirely passive and has elements of active management. It is certainly not the case that the S&P has been with us since the dawn of time, that primitive man discovered fire, and at the same time the S&P came into being. That is definitely not the case. It all started in 1923, when S&P, or Standard & Poor's, began publishing stock indices, which initially included only a few dozen companies. It wasn't until 1957 that the S&P 500 index, as we know it today, was created, comprising 500 companies. The first rule was ranking according to market capitalization, from the largest to the smallest, and according to that, they had a percentage representation, as they still do today. That is the main criterion. Over the next few decades, other conditions were determined, such as the need to trade on the New York Stock Exchange, liquidity requirements, and so on. And since 2000, a detailed methodology has been developed, and even an investment committee within S&P has been established, which can decide which companies to include if their conditions are disputed. In principle, however, additional conditions have been added, such as that the company must have been profitable for the last year and must have more than 50% of its shares freely traded. So what I mean is that, yes, the index selects roughly the 500 largest companies, but there are other conditions and parameters according to which it selects them, and it also regularly rebalances the composition every quarter. Similarly, a portfolio manager of actively managed funds also... Okay, but what if everyone invests passively, for example, in the S&P 500 index? America is doing well. Active portfolio managers are still struggling, so why try something else? If that were the case, then the valuation of the index itself would probably not be the historical P/E ratio of 15 or today's 30, but certainly more, perhaps 40, 50. And the largest companies in the index would grow the most, because they would receive the most money and there would be the greatest concentration there. It could happen that the 5 largest companies would make up as much as 50% of the index. Apple could also have a P/E ratio of up to 50, which would hardly grow in terms of profits. However, the growth in shares would simply be driven by new money from passive investors around the world, and in the event of a slump, almost everyone would buy more. But then, it is very likely that companies that are outside these stock indices will be undervalued. Conversely, the largest companies would be overvalued, and active investors or actively managed funds could take advantage of this undervaluation. Conversely, I can imagine that they could also short the overvalued largest stocks, which could lead to a rebalancing of valuations. The S&P 500 index, at least for the largest companies, is likely to decline. And overall, it may no longer be so attractive for passive investors, who may seek out actively managed funds that could generate some excess returns. This should then lead to a certain degree of equalization and market redistribution, where some investors will remain passive. But on the other hand, there will be more active investors, or rather, investors in actively managed funds. But what can we take away from this? Is passive investing really as passive as they say? Actually, yes. But you need to make a few important decisions that aren't entirely passive. That means choosing the right index, the right ETF manager, broker, currency, exchange, and then automating everything correctly, and only then will our investing be truly passive. At least at first glance, because if we look inside the indices themselves, they are also governed by predetermined rules. It's not just a matter of taking the 500 largest companies in the US, but they must also meet other criteria, such as profitability, a certain percentage of freely traded shares, regular rebalancing, and so on. These are all elements of active selection. But otherwise, it is mostly passive, and above all, it is much cheaper than active funds. And what about you? How do you view passive investing? Do you think it is fully passive, or do you see that it is not as simple as it seems at first glance? Post your answers in the comments, and thanks a lot for now.